Hey guys, welcome. I'm Jay. This is smarthelping.com and it is a financial model template tutorial. This is the first one. I'm going to do these on a lot of models over the next coming years, and it's going to be more of an in-depth view of how the model works, how to use it, very nuanced look. So we're going to start on the construction business financial model. I think that's a good one to start. It's got a fair amount of complexity, and I think it's going to be a great one to look at. Before I get started, remember this template you can buy at smarthelping.com. The exact one I'm going to go over, if you go to the smarthelping.com, General Industries, go to scroll down to the C's, and look for construction business. Here it is. So this model I built, and this one I did in the last 12 months. You can buy it for $75, and I'm going to walk you through exactly how this model you purchase works. So let's say you buy it, you open it up. Let's go back to the Excel sheet. You open it up here, and this is what you see. So I believe going through and making the simplest initial use of the model to get a feel for it is best, and then you can start to scale out your uses of it as you get more comfortable with all the different functionalities. Now I'm going to go through it like I'm a brand new person using this, and hopefully that helps you guys. All of the financial startup models I do are structured in this way in general. So just, this could be helpful even if you're not looking at the construction business model. Maybe you're looking at a different model I've done. The general flow is similar. Now this will have specific logic for revenues and some of the expenses, but we'll get into it. So, let's say I'm starting off. Let's just say it's 2025. So I'll change the year here. And remember, if you do change the year, that's the one thing you need to make sure is you adjust any dates. So right now from 2025 to 2033 is a 9-year summary. Let's say I want to do a full 10-year. And remember, you can stop this at any month. We're going to go all the way to the 10th year, or the end of the 10th year, December 2034 in this case. We're going to select no on the exit terminal value. Don't worry about the debt. We're zeroing out taxes for now. These should all be 0 when you're done with your forecast, but right now, like I just adjusted the dates, so these are going to be off until I fix that. The other tabs with dates on them will be here. So on the other OPEX tab, we'll want to make this start year 2025. CapEx 2025. And then that should, and the debt tab as well. That should have, yeah, okay, perfect. So we got our, general structure. This is not too big of a deal. Just the date, the timing of the forecast is going to be maximum of 10 years. Revenue assumption. So what I've done is I've zeroed out type 2 job and type 3 jobs. And this construction financial model allows you to forecast the economics of up to 3 different job types. They all have the same configuration outline, but you can obviously put in your own numbers for each one. And to help you guys understand it, I'm going to zero out the first one and just put in a sample of one job and go through all the different things to think about when you're doing that. So let me zero this out, zero all these out, and this 0. Okay, now the focus of this model is primarily a cash requirement and cash flow forecast. It's going to show you how much money do you need to get started, what are your profits going to look like over 10 years based on these different assumptions over time. So we start with job type 1. Let's just say in this case we're going to start our first job in month 4, which would be April of 2025 in this case. So what's interesting, we have our months going across the top here. This will apply in 2 different ways. The first is for the new job started per month. This is actually following the month of the actual forecast. So month 1 is January, 2, etc., and so on. That will be completely matched up with this month number here. So if I start one job in month 4, okay, I've started a construction job. This is let's just say we're going to do a road construction, and on average, these road construction jobs are going to take 4 months to complete. So in month 4, I start my first one. So that's going to start driving the data, but I have to put in some data here. And the next thing I do is the next row is percentage of job completed per month on average. So what this says is, and this will drive earned revenue versus unearned revenue or receivables. This is essentially like when you, let's say you're manufacturing, when you ship an item, this is like when you complete a percentage of it, that's like shipping an item as far as recognizing revenue and reconciling that with cash. So we'll say maybe we complete an even amount each month. So I'd put 25% in month 1, 2, 3, and 4. Now notice how I went back to month 1, and that's because this model is built for arbitrarily large jobs that are starting in any given month. So this row matches up with the months of the forecasted period. But all these other rows here, all 4 of these other rows, month 1 is always going to be whatever month 1 is for the life of a given job. So in this case, month 1 for this job is month 4. So in month 4, I need to start counting for this cohort. And I've used a lot of advanced cohort modeling techniques, which I'll get into as we go along here. But in this case, it's saying 25% of the job is completed in month 1, 2, 3, and 4. You'll see how that's important as we go down. So let's look at average value per job. So this is, let's say we're going to do this construction job for a roadway, and we're going to charge let's say 25 million. Okay, so now if you look, what's our current system or our current monthly detail look like? Well, we've earned 25% of that revenue, total revenue amount in each of the 4 months starting in April. If I were to change that, let's say we started in February with our first job. Well, now look, now we have revenue starting in February, and it goes for 4 months, and those 4 months follow these percentages. Now let's say, maybe we do 20% month 1, 20% month 2, and then you kick it up in the last 2 months and go 30%. Well, in that case, you now have updated numbers for these periods. If you were again to go back and say this job actually started in, let's say April again, you can see this adjusts back over to April with the right numbers. So that's the dynamic nature of the job start and when you're completing things. Let's just go back and make it an easy 25% in across 4 months, 25 million. Now we also have to look at cash collected. So one of the big things with construction is you're paying vendors, you're collecting money from customers. So what's the timing look like for that? Well, in this case, you're able to model, let's say any kind of payment terms. So in this case, we're completing the jobs a quarter in each month, but let's say you want to collect 50% of the money of the job up front and then the other 50 at the end of the job. Now you have a reconciliation of cash flow. So if we look at the cash flow statement, here's when you're collecting the cash, see month 1 and month 4, but here's when you're recognizing revenue, and this reconciles the actual amount. So we know over the period, the net is 25 million. Now this other OpEx, let's see we'll zero that out. Let me zero this out for now, just to make it simple. So you can see on our monthly detail, so far we've got revenue earned and cash collected, and that's all we have in the whole model right now. Oh, I do have some CapEx. Let me zero this out as well. And startup costs, zero that out. So all that exists is this. Now, what happens if you collect your cash all up front? Well, in that case, you're going to have a liability because you've got work that you still need to do, but you've collected all the money up front. So you can see on the balance sheet, this is actually going to have a negative for unrecognized revenue. Now, technically, it could be a liability down here, but I just did one row, and if it's a positive, it's an accounts receivable. If it's negative, it's unrecognized revenue. So that's the balance you owe to the customer in terms of the value they've paid versus what you've actually done or need to still do. So that's completely dynamic. Now, if you had a receivable, you would have a receivable if, let's say, you collect 50% in month 3 and 50% in month 4, but you're doing some of the work here. So you're completing the work, billing the customer, but they're not paying you till over here. Well, in that case, you're going to have receivables until they start paying that down. And now you can see, look, it's a positive number. Here's your receivables, and this all balances out. Here's your check for account assets equal liabilities plus owner's equity. All this is all coded correctly. So that could be the case, and it just depends. Let's just go back and put it at 50% up front, 50% at the end. And these could be this, if the job takes 12 months, then you could put the percentages over 12 months or however long it takes, and that will dynamically apply to every new job that started in the forecasted period. And the cash collected will also apply dynamically and in the right months. You can see here on the matrix, this is where we're doing this, where we start counting. We've got recognized revenue here. Then you can see here's the cash flow reconciliation. We'll have some more stuff as we go down through here. Okay, so pretty simple so far. If we look at our income statement, you've got revenue. What is other OPEX? What do we have here? Oh, a percentage. Okay, zero that out too. Okay, so all we should have is revenue on the income statement. And cash flow statement, we have some cash flow reconciliations. Now, the next row is your average material cost for the job. Now, I wanted a single input here, but I also wanted to give the user a way to come up with this in a more detailed way. So material cost could be, let's zero these out. Let's say, you've got concrete, 1 million. I don't know. It's a lot of concrete. Something else, 500,000. Whatever materials or whatever things that you have to pay for to get the job done, you can put in here. And the total amount for the job, you can put in this materials line. And then you could put when you're paying for those materials. Again, it could just match when you're completing the job. So if you complete 25%, you're going to pay for 25% of materials in month 1, etc., and forward. You can just have it match up that, which is probably the most common thing, but it could be different if you have payment terms. Let's say, month 1 for this payment would be month 4 of this because your job started in month 4. So maybe if you had nice terms, you don't have to pay for anything for that job until the end of it. Or maybe you got 30-day terms, so you pay 100 in month 2, but you still have that buffer for a month. However it works, you can put that in there for your specific case. I'm going to just do percentage paid as the job's completed, collecting more cash up front. The 25 million, 50% up front, 50% here. Now this is just going to go to cash flow as an expense. So whatever you put in this percentage, that's going to hit the expenses in that month relative to how it is. So if we did 25%, it's just taking the full $1,050,000 and going 25% in each month. So now we've got some revenues, we've got some material costs, and we've got total construction costs now equal to the $1,050,000. Total revenue, 25 million. And if you go down here, you can see net income would be 23,950,000. Okay, so you followed along so far, pretty straightforward. The next part is equipment rental costs. So this is if you're not buying equipment, but you're renting it. And what you would do is go to the construction cost detail for equipment for job type 1. And you could configure this differently for each of the 3 job types, depending on how they work. And let's say, for these 4 months, your rent cost for bulldozers is going to be, maybe $1 million. Maybe you've got rent for other machinery, another, you can itemize it out here and list it as much as you want. Whatever the costs are. So here, let's just say 2.6 million for equipment per job. Now, you can also define when you're paying for that. And again, the most simplistic way is just to say, as the job's completed, that represents the percentage of when you pay for this total cost for each job. And again, this will apply dynamically based on the job counts you add each month over time. But right now we're just showing one job started in month 4 with these stats, and here's what goes on. So now this 2.6 million equipment rental costs here, and I separated these out because they're bigger in wages. These are like bigger items that are variable that I needed to make dynamic. You've also got other OpEx that will happen here, like different overheads, general managers, all the different overheads, and we'll get into that further as we go. But so now we've added 2.6 million in costs. So now our total construction cost over the 4 months is 3.6 million. Here's our gross profit per month, net income. You can see the actual cash flow that's happening each month. Balance sheet will show your cash balance over time based on all these things happening. And in this case, we made a net of 21,350,000, which should match the net income because there's nothing else, and it does. Okay, so now you've got your job counts, you've got when it's completed, the revenue, collections, the material and equipment rental costs. You know how all this works. And again, all these 4 work the same way. This one is following the month of the forecast period. These are based on the age of the job when it starts. Okay, so the other thing we have with these jobs is you're going to have workers. Let's say we're going to do 3 worker types. Type 1 is going to be maybe a supervisor. You have one of those. Type 2, maybe some type of manager, and then maybe you've got 10 laborers. Now, if you don't use all these, that's fine. We'll get into, all you have to do is make sure there's some value in these boxes here, but you can keep this as 0 if it's not counted, and then that'll flow through fine. So how do we figure out this? Well, we need to know, let's give them 15% payroll tax benefits, but we need to know how much overtime versus regular hours are they working in a year, and we can then define a weighted average pay rate, which will pop in here. So let's say on average, a worker will do, and you'll input this based on whatever your business, however you plan on it to work. But let's say you work for 49 weeks out of the year for this guy or this job type, and they work 50 hours a week on average. And of that, let's say 10 hours is overtime, 40 hours is regular. So what's that? 80% or 20% is overtime. So that's 10 hours of overtime across 49 weeks. It's 490, and then we can do the same calculation over here, but do 0.8. And then the total, so there's 2,450 hours in a year, and let's just check that math. We do 49 weeks times 50 hours, 2,450, 2,450. So you can enter whatever numbers make sense for your situation, and then you just define the pay rate. Let's say this person's making 25 regular and overtime. Well, hold on, let's do this easier. $30 regular rate, overtime's time and a half, so 45. Now you have a weighted average rate that we can apply to figure out the wages paid to this worker type. And we're going to say for this worker type, the average hours worked per job is, let's say 4 months. So it'll be this total. What's that? 2,450. 4 out of 12 months, that's 33%. So on average, they work about 816 hours on a job. We'll put that for all 3. We'll say this is the same for all 3, but then this rate's a little bit lower, maybe 20, and then time and a half would be 30. We'll keep this the same. And then for these, we're not using them, but we don't want this div error, so all we do is just simply, you can enter a 1 in all of these. I actually just need to do the first 2. That's fine. And then this, all we really want to know is this number, these 2. the total wages you're paying per job, and the total payroll you're paying per job. Now this 209,000 in wages based on the hours worked per job, the average wage rate, and the count of people working of each job type. We'll all work together to figure the wages out. So this is going to be happening as the job is completed. So if we have 25% each month, it just takes this total times 25%. So if we go over to our monthly detail, we can see now here's our wages. So there's the 297,000, which is this, divided by 4. Here's the amount in each period. We also have the payroll tax and benefits, same deal. Over 4 months, there's 11,000 a month. It equals 44,554, which is this. And keep in mind, all this is happening dynamically. So I could say, 3 jobs are happening here, and now look, all my costs are going to go up by 3. Everything just tripled. Revenues, expenses, everything. So that's the beauty of this model is it's very scalable, but you can configure some high-level assumptions about the job type, and you can do this for up to 3 job types, and it all works dynamically in the same way. So it's a very, very useful way to build a financial projection for any kind of construction business. Very, very flexible. All right, so we've got revenue, we've got wages. Oh, this is a little bit of a sanity check. So this is saying for each month of the job, of the life of the job, so this is saying the job's 4 months, how many hours per day are they working in each of these months? And this is kind of a sanity check. So based on working, 816 hours for the job and doing 25% in each month and the amount of days in the month, we're doing each, on average, this person is working 7.8 hours a day. Obviously, if it said, let's say the average job takes 20, let's say 3,500 hours. Well, now you're going to see, oh, this doesn't make any sense. It's saying that, well, in this case, a worker is working 33 hours, which is not feasible. It doesn't make sense. Now, if you had 10 workers, each working 35, well, that'd be not much. 35. What was our initial number? I think 817 or so. You can see this is the same whether this is 10 or 1 because it's on a per worker basis. So it's just doing the hours worked over the days in the month and the percentage completed in each month. So this is a sanity check to make sure your numbers aren't insane and are reasonable. Oop. Which they do make sense in this case. And again, these div errors are fine. It's not going to hurt anything. All we need to make sure is if you don't use a worker type slot, just make sure you put a 1 in this. I believe, actually, all you need to do is put a 1 in the first box here. And then this won't be a div error. And if you do add slots later or do something else, you can then just fill this in here, no issue. All right. Let's look at the matrix again. So we have our cash collected. We have materials getting paid for. This is where all the fun logic is happening, and this all gets propagated through to the monthly detail, which goes to the income statement, balance sheet, cash flow statement. So right now, what we have is we have some earned revenue. We have when the cash is collected. We can see if we're looking at the cash flow, we collect 37 million up front, which is half. And hang on, I think I still have these at 3. Let me put this back to 1 job so it's easier to see the numbers. So 1 job for 25 million, half up front, half in the end. Here's your cost to get all the construction materials, rental, any wages, labor, all that, payroll taxes. We're making our gross profit per period, which is 21 million. When we reconcile the cash, we end up making it into 21,000,008 because we have no other expenses. And that's pretty much it. Now, when we move towards the rest of the model, you're going to have other OPEX. So this would be like things like maybe a CEO, COO, high-level managers, any fixed costs that it takes to run the company that are not counted for in the construction details directly, you can put in here. So all you do is put in the monthly cost, and this is the cost. It can change over time. We're just going to say it's $3,000 a month in each year. Start month, and there's a bunch of slots for sales and marketing, G&A, R&D. So now when I put this cost in here, you can see we now have a G&A cost popping in right here. Now I shouldn't start it till April 2025 because that's when we're actually beginning operations. So I'll change the date there so it lines up. That's going to affect the numbers here. What else do we have? Oh, there's a filler down here to say any cost as a direct percentage of revenue, and you could fill in the start month of this. This was 2%. It would just take the revenue amount times that percentage. If we look at the executive summary, we can see the high level. Here's your revenue earned, construction costs, other costs, total expenses, EBITDA, reconciling of different cash flow items, the actual cash flow per period. Now, in this case, since you're collecting 50% of the receipt, you're collecting 50% of the money for the job from the customer up front, you don't actually have any initial investments because you're getting enough to fund everything with that initial amount, and then you're making a profit over the course of the job. However, what if we say we actually collect no money up front and 50% in month 3 and 4? Well, now we're going to have some receivables, but we're also going to have a cash requirement. So if we look at our monthly detail in month 1, we actually collect no money. We do recognize some revenue because we've completed some of the job, but we haven't actually collected the money. We have expenses here, so we got to pay for those. So what do? Well, we need $1 million in month 1. And then we need another $1 million in month 2. And then month 3, we finally have some profit or some cash coming in to pay for the expenses and stuff. So this will drive the model's equity requirement, which is this here. So this is looking at the total projection. You can fill in these assumptions for all your different, as many jobs you think you're going to start per month, all their costs, the timing of all that, and then the net effect will be a monthly cash flow number, and this is pulling the minimum cash position, meaning you need to inject this much cash into the business to keep the cash position at 0 or higher, which is what we saw for. That's why you see a 0 here for the cash position in May of 2025. So we've got an investment that trickles down as we use it based on the negative cash flows that are happening. It doesn't ever go below 0, and then it goes up from there. Now that will be dynamic based on your costs and everything else. You could fund some of your startup costs with financing. Let's say you get a $500,000 loan. That will reduce your startup cost, but it will then have some debt. If we have debt starting in April, you can see balance sheet. Now we've got some debt. Cash is going to be affected because we now have debt service, so interest, principal. So that's happening in here. These visuals are going to show you a 10-year summary of each key financial line item. I'm only doing one job, so there's just one bar for the data. What else do we got in here? Revenue, construction costs. Here's all the items in one spot. You can see the cash flow. I've got a discounted cash flow analysis here. And now this shows, let's go, okay, as we're talking about equity required, so let's go back here. Let's zero out this so there's no debt. We're just going to take out equity. So we want to look at the cap table. This cap table is going to allow you to put in investor contributions outside and inside. The simplest way people do it is just put 100% for common shares, arbitrary share count, and you just put in 100% here. This specific cell is an autofill by just looking at the total equity required and then reducing any amounts that have been contributed elsewhere, and then they'll just put in the rest there. So if you make this 100% and don't touch anything else, zero all these other numbers out, this will just be your initial investment of the owner. If there's only one owner, that's fine. And it'll just show the cash contributions, distributions, and the IRR. Now, if this is an outside investor, maybe they only get 20%. Maybe the owners contribute, maybe 250,000 or whatever, what have you, and they have 80% ownership, and then you have a split of the monies based on those percentages. Now you can get more complex. You just make sure this top section plus the bottom section equals 100% if you're doing percentages. And then you can also add Class A and B shares. And same rule applies to this top section versus the bottom. The total should add up to 100%. So you shouldn't put like 100% here and then 50% here. That is not right. You'll have an error. There we go, 2080. We got our checks looking good. So that's it for the cap table. CapEx, let's say if you do buy equipment, say we buy $5 million of equipment, that is going to happen in whatever month you define here. Let's say you do it in March, $5 million, and that will hit, if we look at our cash flow, there's that amount hitting in the CapEx. It's also going to hit on depreciation on the income statement, and it will affect the initial equity requirement as well to figure out, well, where's that extra cash going to come from to pay for that? And you could finance some of it by putting in some debt here. The general idea is you have an initial startup, figure out how much burn you're going to have before you're profitable, and then what does the returns look like. That's what the model will do, and it'll show the proper timing for all the different cash flows and items as you work through the assumptions. It's a very good operating model. It's a good investment analysis model. It's just really, really dynamic. Startup costs, maybe you have some web design, other things. You can also put a reserve here if you want to say, well, based on all my assumptions, I need this much equity, but that assumes I now have no reserve. So let's say you also want to account for, 200,000 in reserve. And what that means is technically then when the balance sheet hits zero, you actually would have that reserve amount still in there because you've accounted for it here, and the cash requirements are based on that reserve having to be funded. Also, you can see those startup costs are going to hit and affect cash flow. Let me see right here. And that's also going to affect your max minimum cash flow on the monthly detail, which is what we're using to figure out how much cash we need. Annual details, just showing you the annual summary. What else do we need to look at? I mean, that's pretty much it. Oh, on the distributions here, so this is discounted cash flow analysis, and looking at all the things we just filled out and figuring out, well, here's the IRR of the project. You can also do a discounted cash flow analysis with a discount rate to figure out the net present value and present value. You can do a discounted cash flow for investor and owner as well, based on their cash requirements and distributions, and then a discount rate for each of them. And now one template I do have that would help you with this is coming up with the right discount rate. You definitely could use, if we look at smarthelping.com, we look at the weighted average cost of capital calculator. This is a nice simulation to walk you through how much debt you have, what's the weighted average interest rate, how much equity you have, and what's the cost of equity. It's a fairly complex calculation if you don't do it all the time, but it basically comes up with a percentage that you can then plug into here as the discount rate, and it tells you if the project is going to produce excess gains, essentially meaning if the NPV is going to be positive or not. And it's kind of a relationship with that in the IRR, because this IRR tells you at what point is your net present value zero if this were to be the discount rate, which you can see if I plug that in here, you now have a zero NPV. So that's why IRR is pretty important, and it kind of is related to discounted cash flow analysis, and that's why it's put in here. let's see. So if we, let's zero this out just so we don't have negatives for these other 2 years since we didn't fill any other data out. Oh, right, this is negative because the investor in this case at 20% ownership is not actually making enough back to cover their costs in year one. Again, these are just arbitrary based on what I just put in for one job, not an actual case. Like, let's say you wanted to propagate this, you could say, well, I'm going to start one job a month. Those are the specs, and do that for the whole rest of the model. Now you see, yeah, now you see numbers for the whole model. And if you look at the monthly detail, here's the cash coming in, the cost for all these different jobs happening over time based on all those assumptions, and the cash flow. Here's the executive summary, what it looked like over 10 years. Now you've got visuals. So pretty useful template. You can see cash flow statement, balance sheet, all balances out. Income statement. And that's pretty much it. So that will basically conclude the tutorial for the construction business financial model. After viewing that, you should have a pretty good idea of how to use this and all the different nuances that come along with it. Remember, I do, oh shoot, I wasn't looking at the, I had the website thing up there at the end. What was I showing you guys? Oh, I think I put in data for having one job per month start. There's some visuals, an executive summary, discounted cash flow analysis. This is where you'd put in the discount rate that we looked at on the weighted average cost of capital in these yellow boxes here. You got the monthly detail showing you the revenues, all these jobs that have been started, the costs, cash flow. What else did we look at? I guess that was it. Just, and then you got cash flow, balance sheet, balancing, monthly. And I believe that is it. What else? Oh, okay, yeah. So I plan on doing more of these, and not all the models are this complex. I just thought to make this construction model very usable for the most amount of people, but also not too specific, this was the best way to lay out these assumptions to define revenues and expenses over time and make it really dynamic. If you want to check out more, I've got over 150 financial models here that are set up similar to what we just went over. I've got SaaS models, software as a service, also subscription and membership, recurring revenue businesses in here, real estate underwriting tools for all kinds of different commercial and residential real estate projects. We've got over 30, or I think 50, 52 industry specific models. This is where we see the construction business model that we just went over, but there's, a lot of these. They all work, they're all unique and work differently. Joint venture cash flow waterfalls, a lot of different things there for preferred return, preferred equity, IRR hurdles, all kinds of different deal structures, accounting tools, HR management tools, personal finance, Google Sheet templates, sales pipeline stuff, and general business valuation. So you can get all these. You can buy them in bundles. I have discounts. Also, if you buy 3 to 9 templates, 30%, 10 to 19, 40%, 20 more, 50%. And then the best deal is just buying everything for $9.99. It's over 150 templates, and it's if you're trying to expand your knowledge in finance, this is a great place to start and use as a reference for your career. This is really, really valuable. All right, that's all I got for you. Remember, I do financial modeling custom work as well for $165 an hour, so you can check out that here. You can read more about my general financial model template strategy here, and look at the FAQ for questions on all this stuff. And I'll see you guys on the next one. I'll post this to YouTube. It's going to be, like I said, it'll be part of a new, it's going to be part of a new series or new playlist for template tutorials in general. It's more granular. It's a little bit slower paced. It's more detailed as well, and I'll do these for a lot more. But I think it's with these models, it's really good to start off small, figure out how the assumptions work, get used to it, and then you can scale up from there and understand how the numbers are working. And then you can also modify it if you want from there as well. So like the video, subscribe, check out more on the website, and I will see you guys on the next one.